Do you know it's possible to earn some returns every month by investing in mutual funds? Did you know that investing in mutual funds can also yield better returns than the savings account interest or even some of the fixed deposit interest without any lock in period? What are the precautions we need to take while investing in mutual funds and how to find better mutual funds in this falling 2025 market? Friends, I will cover all these topics and some more topics in this video, but after a small story. There was a man in 1990, it's a real story, okay? A young middle class man from Chennai decided to invest in mutual funds after learning about the benefits of systematic investment plan, which is nothing but SIP. Mutual funds were still a relatively new investment for most of the people in India during that time. Inspired by the idea of long term investing, he started an SIP of just 1000 rupees per month in an equity mutual fund in 1990. So he invested a total of 3 lakh rupees, 1000 rupees per month for 25 years. Despite the volatility and market crashes, which includes 2008 financial crisis and 2020 pandemic crash, he remained committed for his investment. By any chance, do you know what would be his portfolio size in 2020 after 25 years? Friends, it's not 10 lakh, it's not 25 lakh, it's not 50 lakh, it's not 1 crore, but it is 2.5 crore rupees in 2020. Remember, he invested only a total of 3 lakh rupees in 25 years. This is the power of long term investment. Mutual Fund Sahi Hai. It is a campaign launched by Association of Mutual Funds India, AMFI, played a very big role to popularize mutual funds in India. One small glimpse, as I said earlier, it is possible to earn monthly returns from mutual funds using SWP option. SWP stands for Systematic Withdrawal Plan. It allows investors to withdraw fixed amount every month or even every quarter. I will cover in detail about SWP in the later part of the video. Okay. Now, liquid funds. Let's say you are a businessman. You got some cash and you want that money after 1 week or after 2 weeks. But if you keep that amount in a bank account, it will not generate much returns, right? At the same time, even if you go for FD for 1 week, 2 week, it doesn't generate much returns. But there is an option in mutual fund which is called as liquid funds, where you can deposit, where you can deploy your cash for 1 week or 2 week, and you can earn better returns as compared to savings bank account interest or even fixed deposit interest. I will cover once again more in detail about liquid funds in the later part of the video. Now, what are mutual funds actually? Okay, I will take one simple example. Let's say you have a plan to construct a house. Now you have two options. One option is, after getting the blueprint, bring everything, all the materials required to build an house, and you bring all the people to construct a house. You monitor everything, each and everything, you monitor everything, and then you will complete a house. This is one option. The second best option is, let's say you are working person, you don't have time to bring the material or to monitor the people, you don't have time for all these things. So what you do is, you will give the entire contract to one professional who has lot experience of to construct an house. So this is best option, right? This is one of the option if you don't have time or if you don't have expertise while constructing a house, right? Mutual funds are also same. If you have the ability to invest in stocks and to make money from stock market, then it is a best option, you can go for it. Otherwise, if you don't have the ability, knowledge, skill or time to invest in stock market and to fetch the returns from stock market, then mutual funds are the best option. So basically there will be an dedicated manager. Basically what happens is, mutual funds, they collect money from many investors, and they invest that particular money, pool of money, in stocks, bonds, or even some other securities. Okay, so professional fund managers handle all these investment, and whatever the returns they generate, they share that returns to everyone. Now, what is the profit for them? Suppose, let's say they collect the fund and they will share the entire profit. No, it doesn't happen like that. So, what happens is there is a concept called as expense ratio. So basically, in expense ratio, it is an annual fee charged by the fund house for managing your investment. Let's say you have invested 1 lakh rupees, and that 1 lakh is generated 10,000 of profit. Now the total fund value is 1 lakh 10,000 rupees, right? If the expense ratio is 1%, so what it means is they will deduct 1% from that 1 lakh 10,000 rupees towards their fee. That's how these big mutual funds make money. Okay, I hope this is the clear. So it is a percentage of total assets in the fund and covers their expenses like management fees, administrative costs, etc. Okay, so what you should know is lower expense ratio will maximize your returns, right? Suppose, let's say a fund has generated 10% returns. If the expense ratio is 2%, then you will get approximately only 8% of the returns, right? Because fund will take the 2%. So that is why you should look for the mutual funds which offer, which comes with a less expense ratio. Okay, so in India the funds will charge, somewhere between 0.06 to 2.5% as their expense ratio. Now, this is one simple example. Okay, this is one simple example for the expense ratio. Uh, HDFC Asset Allocator FIF. You can see it charges only 0.06%. Kotak Nifty, it charges only 0.11%. So Motilal Oswal 0.2. Edelweiss Nifty 0.21. ICICI Pro Asset 0.23. Okay, 0.23. See, it goes like this, right? So these are the funds houses which charges or which comes with very less expense ratio in India. Now, so I fetch this information from an article. Do you want the link to that article? If yes, comment below. I will share the link for this article so that you can get all the information about all the mutual funds which comes with very less expense ratio. Let's move on. Now, types of mutual funds in India. Okay, so SEBI has made this. Okay, it's not any fund manager, it's not any trader, it's not any investor. SEBI has classified mutual funds into different categories to ensure uniformity and simplicity while making an investment for investors. So the first type of fund is equity funds. So these are all very popular funds. Okay, equity mutual funds are very popular, and basically they invest primarily in stocks, in different stocks. It may be a large cap, it may be a mid cap, it may be there are so many things. Okay, again, you can see this is the information. Many people get confused with different types of mutual funds. Okay, so basically there are only 5 categories, but under those 5 categories there will be different categories. For example, this is an equity mutual fund, right? See, in equity it is a large cap fund. So large cap fund means 80% of the fund will be allocated to the large cap stocks, which means blue chip stocks. So blue chip stock usually they are very safer, but they generate less returns compared to other things. Now, mid cap fund. So, in mid cap fund, 65% of the fund allocated to mid cap stocks. Again, in this case, it will generate little extra returns compared to the large cap, but the risk is also little extra compared to the large cap. Now, small cap fund. So once again, 65% it will allocate to the small cap. Once again, it has a possibility of generating more returns compared to mid cap, large cap, whereas the risk is also a little higher. So the list goes on like this: multi-cap fund, large and mid-cap fund. It's a combination. Dividend yield fund, they invest only in the dividend yielding stocks. It goes on like this, right? ELSS. So ELSS is also a famous thing, equity linked saving scheme. So basically it offers tax deduction up to 1.5 lakh, which comes with 3 years. Okay, under ATC it offers tax benefit. So these are all the different funds which comes under equity funds. Okay, don't get confused with this. Okay, so this is one thing. And the next is debt fund. Basically, in this category, the funds will be allocated into fixed income securities like commercial paper, government securities, corporate bonds, like that. For example, all these things, all these funds comes under debt fund. For example, overnight fund, you can invest securities with 1 day maturity. Liquid fund, that's what I just mentioned at the beginning of the video. Low duration fund, money market fund, short duration, it goes on like this. Okay, these are the different types of debt funds. So in equity funds, risk will be high, return will also be high. Whereas in debt funds, risk will be less, it's almost safer compared to equity fund. So return is also lesser compared to the equity fund. Okay. Now, it's a combination. Some people they want the benefits of equity funds as well. Some people they want the security of the debt funds as well. So for such kind of people, mutual funds also have their own category, like hybrid fund. No, it is a combination. It invests both in equity funds and in debt fund as well. The ratio will vary. So in some funds, they allocate 50 to equity, 50% to debt. Some fund 60% to equity, 40% to debt. In some fund, vice versa. For example, 40% to equity, 60% to debt. It goes on like this. There are different types of hybrid funds. For example, these are all the different types of hybrid fund. Conservative hybrid fund, so which means 10 to 25% in equity, rest in debt, which means only this much of capital, it will be little riskier, but rest back of the capital is on the safer side. Whereas balanced hybrid fund, I said 40 to 60 in both equity and debt. So aggressive hybrid fund means most of the fund will goes to equity funds, like 65 to 80%. This is aggressive. So 20%, 20 to 35% of the capital will be allocated to debt funds. So it goes on like this. Okay. So usually most people they go for hybrid funds and they vary with this. Okay, if a person is okay to take little extra risk, they might go for aggressive hybrid fund. But if the person is little conservative but he wants to see little extra returns, then that person will go for conservative hybrid fund. Okay. Next, the fourth option is solution oriented fund. For example, you are planning to retire after 20 years. Okay, you want some lump sum capital at your retirement. For such kind of people, or child marriage. Let's say you have a girl's child or child now. You want some lump sum amount for their education or marriage. So for such kind of thing, the solution oriented funds is a better option. The last option is other funds. So other funds, basically ETF. ETF means index funds. For example, Nifty, Nifty Bs, or Bank Nifty. It goes on like this, right? Basically they track the index for their investment. So for such kind of funds comes under other funds. So basically, SEBI has divided all the mutual funds into 5 category: equity, debt, hybrid, solution, other. So equity, more risk, more returns. Debt, less risk, less returns. Hybrid is a combination of equity and debt. Solution is for a long term, for like retirement, child marriage, etc. Other, it tracks the index. Okay. So these are the different types of mutual funds. Now, systematic withdrawal plan. This is very, very important and very, very beautiful option which comes under mutual funds. So basically, most people know about SIP, right? Which means they allocate some amount every month towards a fund, and there is an option also called as top up. For example, after 1 year, you can increase the amount. For example, let's say you are paying 5,000 rupees every month. You can put up some percentage like 5%, which means from next year, so the 5% of 5,000 will be added and will go towards the fund actually. So the SIP is very, very popular in India. By one fact, in 2024, the overall SIP account in India has crossed 2.5 crore accounts. I'll repeat once again, there are more than 2.5 crore SIP accounts present in India at the end of 2024. It's very interesting, right? So that is SIP. At the same time, SWP is opposite of SIP. So in SWP, what we do is we allocate a big capital, let's say 50 lakh or 1 crore, we allocate a big capital towards a fund, and we will plan to fetch some money every month. Okay, I'll repeat once again. Under SWP, we allocate a lump sum amount like 50 lakh, 1 crore rupees towards a fund, and we will plan to take some money every month. Okay, this comes under SWP. Now you might ask me, how do I generate lump sum money? I don't have lump sum money. Okay, don't worry, I will explain a topic for this in the next part of the video. Okay, so try to understand SWP as of now. Now, let's say you want approximately 50,000 rupees every month. Now you need approximately 50 to 60 lakh rupees. Uh, you want that 50 to 60 lakh rupees towards a fund to fetch that 50,000 rupees every month. Once again, this amount will vary because of the market fluctuation and the performance of the fund as well. But this is an average thumb rule. If the fund is generating 10 to 12% of the returns CAGR, I will explain here. So basically, there is a option called as ticker tape. So this gives a very good. It's a very good tool to screen mutual funds. I will show you one simple example. If you come here, for example, I will go to ticker tape. Okay. So basically, if you come to ticker tape, there is an option called as more, and there is an option called as main mutual fund screener. So here you will get different types of screening option for mutual fund. If you select start screening, see, you will get all type of information here. Do you remember the 5 types of mutual funds I said? Equity, you can shortlist only equity mutual funds. Next is debt. You can shortlist only debt mutual funds. You can shortlist only hybrid mutual funds. You can shortlist like this. Okay. Now you can also go for AUM, and you can also go for CAGR. It goes along like this, right? When it comes to AUM, there is an interesting option. Assets under management for mutual funds crossed 45 trillion rupees in 2024 in India. Okay, so 45 trillion rupees in India. That's an interesting factor, right? Now, let's say for some reason you shortlisted this, and if you click on a fund, it shows everything. For example, what I do is I will cancel this. I will go for SBI equity thing. See, if you open this, it shows 5-year information. So 5-year CAGR is 13.87%, approximately 14%. You can see all the information here, right? Uh, expense ratio 0.73, it is quite decent. It should be, it is better if it is less than 0.5%. Sharp ratio, category expense ratio, you can see all these things. Now you should see exit load. See, exit load is, I will cover more about exit load at the end. So what it means is, uh, if you try to exit, close the mutual fund, which means it will attract before the 12 month means it will attract 1%. Okay, nil after 12 months. So different mutual funds comes with different exit load. You can also remember this. Okay, so this is one of the better tool to shortlist or to study everything about mutual funds. This is one thing. And the next thing is, if I go to funds after ticker tape, we have SWP calculator. Okay, so you can calculate SWP. For example, if I go here, if you type grow SWP calculator, Okay, so you can calculate. Let's say you want 50,000 rupees every month. You want to withdraw 50,000 rupees every month. And in this particular case, in the last mutual fund, it generated around 14% returns by default. Or if you keep your expectation little low, maybe 12%, 12.5, 13%, 12% is a decent thing. Let's say if you have 50 lakh rupees. So this is 50, right? 50 lakh rupees. How much money you want to withdraw? Okay, let's say you want to withdraw 50,000 rupees every month. So expected return per annum. Let's say we will go for 12%, because if you aim for 12% and if you aim for time period, you can see even after 5 years, your capital will be 47,94,000 even after withdrawing 30,000. Let's say you want to withdraw for a more period. See 10 year, if you go to 20 year also, see if you go to 20 year, which means you are investing 50 lakh rupees now, you are withdrawing 50,000 rupees every month. This fund house is generated 12% returns. You have withdrawn every month, you have withdrawn 50,000, which means you have withdrawn close to 1 crore 20 lakh, but still the fund will have 26 lakh 70,000. Okay, so this is the beauty of this tool. You can vary it. For example, let's say instead of 50,000 you want to withdraw only 40,000 every month. So you just see what happens in that case. Even after 20 years, you know the final value will be this, 1 crore 17,000. Okay, it goes on like this. This is the beauty, right? See, if you want to withdraw 50,000 only, that means you need to invest little extra. For example, let's say you will invest 60 lakh. So in that case, you can see if the fund generates 12%, then even after 20 years, the capital will be 1 crore 23 lakh, right? Okay, so this will vary based on the withdrawal per month and also the returns generated by the fund. For example, if the fund generate only 11%, again this will come down, right? So this is how one can plan their SWP. Okay, so now we will go back. So that's all about the SWP. I hope this information is helpful. But now entry matters. This is the most important thing. Be it a trade, be it an investment, or for anything, entry and exit are most important. So definitely, very easy to say. Suppose very easy to say invest at this point of time, invest at this point of time, or invest at this point of time. It's very difficult or practically impossible for everyone and every time to catch the or to invest at the market lows, right? It's not possible. It's highly impossible in the long run. So what you can do is, whenever you can go for 3 4 options. Let's say you have 1 crore rupees, you want to invest one entire 1 crore rupees in SWP. So what you can do is, whenever the market corrects for 5 to 10%, you can invest 25 lakh in one SWP. And after some time, maybe after 3 4 months or after 5 months, if the market shows some more correction or some correction, you can go for investing another 25 lakh rupees. So you can go for like this with 3 4 intervals. Now you might ask me one thing. Let's say, Indra, I have 1 crore rupees. I have invested 25 lakh rupees in one SWP. Remaining 75 lakh, what should I do? Is it a waste of opportunity for that money? No. You can deposit. You can push that 75 lakh rupees in liquid fund, right? So basically your liquid fund will be generating some percentage of returns. It is better than the bank account interest, and sometimes it is also better than the bank FD. Okay, so that is the reason you should play very smartly. You can park the remaining amount in liquid funds, and whenever the market corrects, you can push some portion of the amount to SWP. So in this way, you can plan for your retirement. You can plan for something, for any expense, by by allocating or by utilizing your money effectively, smartly in SWP. Now, now the $1 million question is, how do we generate that lump sum amount for SWP, right? That is the $1 million question. Now it is not very simple, and it is not very straightforward for everyone, friends. That is the reason I explained the story in the beginning. One person in Chennai, he invested 1000 rupees every month for 25 years. So overall 25 years he invested only 3 lakh rupees, only 3 lakh rupees. But his overall lump sum amount after 25 years is 2.5 crore rupees, right? So that's how he generated the lump sum amount. So there is no shortcut for anyone. We should use the SIP option, systematic investment plan. So this is a simple method of investing in mutual funds where you invest a fixed amount of money at regular intervals. You can also go for monthly, or you can also go for quarterly. I suggest to go for monthly because monthly is the best option. And you can also go for the step up option. Let's say inflation is around 7 to 6 to 8% in India, right? You can go for 10% step up. That is a beautiful better option. Let's say if you are investing 5000 rupees every month now, after 1 year, it steps up. It will collect 5000 plus 10% of that 5000. In this way you can go for the step up option. It will be very very wonderful option. And after, if you go for minimum 10 years 15 years, you will automatically end up having lump sum amount. Okay, so this is the only way to generate lump sum amount in mutual funds. Now there is an option called a SIP calculator also. It is there in again in the Grow website. So I will go there. For example, if you go here, there is an option SIP calculator here. You can see you can calculate everything here. Okay, approximately mutual funds yield 10 to 12%. Some mutual funds also gives returns of 15%, but keep it moderate. Let's say you want to invest only 10,000 every month. Okay, and expected returns per annum is 12%. This is ideally, most of the mutual funds or some of the better mutual funds, they give 10 to 15%. So I'm keeping at 12%. If you do the SIP for 10 years, okay, so this is the amount. Invested amount will be 12 lakh and the total value will be 23 lakh. Okay, so this is the one thing. Here that step up option increasing that this amount is not there. So you can also go for time period. For example, instead of 10 year, you want to do this process for 20 years. You can see it will generate approximately 1 crore rupees, right? If it is 12%. If it is, for example, if the returns is 13%, it will increase. Say it went to 1 crore 14 lakh. At the same time, if the return is less 11%, then it will decrease. Okay, so you have invested only 24 lakh rupees overall for 20 years, but the fund will be 87 lakh rupees. Okay, so this is one of the SIP option. People can use SIP. This is a very promising and very interesting or better way to generate a lump sum amount. Okay, so this is all about the SIP. Now going forward, liquid funds. Liquid funds are basically, they are a type of debt mutual fund that invest in short term money market instrument like commercial paper, treasury bills, etc., with which have a maturity period less than 91 days. Okay, so it will invest only in such kind of instruments. Okay, so treasury bills, commercial paper, certificate of deposit, high quality debt securities. Okay, so basically among the mutual funds, liquid funds are the safest category. Okay, the reason is, because of the expiry is very very less, the maturity period is very very less than 90 days. They don't carry the interest rate risk. Okay, that is one thing. And also it is a type of debt fund, right? It is more safer compared to the equity. So this is the beauty of liquid fund. You can invest in liquid fund today, and after 2 days you can withdraw that amount. So that is also possible in liquid fund. So this is a wonderful option. Now the futures is, as I said earlier, maturity of 91 days or less. So hence it reduces the interest rate risk. This is one thing. Safest, not much impact, from interest rate risk. That is one thing. Second thing is high liquidity. You can buy today, you can sell tomorrow or day after tomorrow, 1 day, 2 days. You can sell even after 1 day. That's also possible. 2 3 days, it's possible. So there is a high liquidity, and it is lower risk because compared to the other mutual funds like equity fund, etc. In this case the funds will be allocated to the debt funds, right? So hence it carries very less risk compared to other type of funds, and stable returns. So I don't say the returns will be guaranteed, but it will, in most of the cases, it generate better returns, definitely better returns compared to savings bank account interest, and in most cases better returns compared to even bank fixed deposit rates. So these are some of the important features of liquid funds. Now, the popular liquid fund in India is Liquid Case by Zerodha. So this is one of the popular liquid fund, and most of the traders, what they do is when they have a surplus cash, so they don't keep it in the trading account. They will push that particular free cash to the liquid case. Then they will pledge that liquid case and they use that pledged amount for their trading. So this is what most of the traders does is. So whenever you have a liquid cash, instead of keeping it in your savings bank account or instead of keeping it in your trading account, you can push that money towards liquid case. You can automatically, suppose you want to use that money, means you can sell the liquid case immediately. You can use that money for your trading or for other investments actually. Now, precautions while investing in 2025 in mutual funds, especially. Okay, check expense ratio. As I said earlier, expense ratio plays a very, very crucial role. So, if they, I have seen some of the mutual funds, they charge expense ratio up to 2%, 1.89%. This is, I'm not against them, but it reduces the returns for an investor, right? For example, if you invest 1 lakh rupees, if it generates 10,000 rupees, uh, they take 1.89% for that entire 1 lakh 10,000 rupees, not for 10,000. Okay, they take 1.8% of entire fund, 1.10 lakh. So 1 lakh 10,000 rupees. So this is very high. It reduces the returns for the investors, right? So if you are really smart, if you are really intelligent, you should go for the mutual funds which comes with or which offers less expense ratio. Okay, so this is one thing. And entry load. And nowadays in India, most of the mutual funds, they don't charge entry load, but you can check. It is better to check the entry load instead of investing blindly. You can check all these things in ticker tape. Now, exit load. Some of the mutual funds, they charge exit load in a very, very smart manner. Okay, so there will be options like, they come up with options like this. Okay, nil up to 10% of units for remaining, which means many people, they get confused when they see nil. They have an habit of reading only one line. When they see nil, they might think or they might assume it is nil for everything, but that is not the case. So in any scenario, it is nil up to 10%. Is not guaranteeing. Okay, so which means for the remaining 90%, he is charging the exit load. Okay, that is one thing. Especially in investing mutual funds, you have to see all these things. For the remaining units, he is charging 2% mutual fund. I'll repeat once again, he's charging 2% mutual fund. If you exit within an year, for example, let's say you invested 1 lakh rupees now. Let's say after within 1 year, maybe after 10 months, let's say the fund has not generated any money. For example, the balance is only 1 lakh rupees. If you try to close it, he will take the 2,000 rupees and he will give you only 98,000. Okay, so that's what he is saying. And after 365 days, between 730 day, he will charge only 1% exit load. It is nil only after 730, approximately 2 years. Okay, so this exit load also plays a very, very crucial role. For example, let's say You have kept the fund for 10 years. Let's say from 1 lakh, it went till maybe, I'm just taking an example, okay? It went till maybe 10 lakh, 25 lakh. So he is taking 2% of the entire fund, not from the profit, okay? He's taking 2% from the overall fund. So that is why you should also look at all these criteria, exit load, to get a better returns from mutual funds. Now, check lock-in period. This is one thing. Okay, if you are investing in ELSS, that is tax saving under ATC in around 1.5 lakh, then that's a different story because that comes with a 3-year lock-in period. Apart from that, there are some mutual funds also, they come up with some lock-in period, like lock-in period of 1 year, lock-in period of 6 months, and it comes like that. So it is better to check the lock-in period because you never know, right? For example, there might be some emergency after 2-3 months. There might be some health emergency, family emergency after few months. If you should be in a position to close that particular mutual fund with less fees as much as possible. That's why it is better if you check the lock-in period as well. Okay, you can see you should confirm lock-in period is 0 years. That is the most important thing. Now, that tax structure for mutual funds. So basically, I say tax structure is a little complicated compared to other, investing vehicles in India. You can leave it to your CA, but I will try to explain in a simple manner. So basically, there are two methods, right? Short-term capital gain, long-term capital gain in India. So capital gain means, let's say you have a house or you have a plot, you bought it today of maybe for example 10 lakh rupees. After 10 years you sold it for 1 crore rupees. This 90 lakh is the capital gain. Okay, now in real estate, when it comes to real estate, if it is less than 2 years, government of India recognize it as short term capital gain tax. If the holding duration exceeds 2 years, means it comes under long term capital gain tax, especially for real estate, not for mutual funds. Okay, but when it comes to you know mutual fund, it is varies. It is different for equity fund and it is different for debt fund. So for equity fund it is 1 year, debt fund it is 3 years. It comes like that. For example, I would say it is better to go for ticker tape and look for the tax implication. There is an option called as tax implication. I will show it. It is better. For example, it says invested period is less than 1 year, means it attracts short term capital gain. It is taxed at 20%. If the invested holding period is greater than 1 year, it is considered as long term capital gain tax. It is taxed at 12.5%. So basically this is an equity fund. Okay, so any fund, you go to ticker tape and check the tax simplification. So most of the people, I assuming, they plan to invest for a long term in a mutual fund. In that case they should be ready for this, because you can't escape two things in life, death and tax. So the governments are after you to collect the money in form of tax. So even if you invest in mutual funds, if you hold for more than 1 year, this is the tax they attract. So what you can do is you can go to ticker tape and you can check the tax simplification option. You will get a more clarity. Now, risk in mutual funds. Don't assume mutual funds are risk free, because if you take equity mutual fund, let's say in equity mutual fund, definitely they don't allocate the entire capital in one stock. Let's say they have allocated entire capital in 10 stocks. Suppose they the one stock which attracted the majority of their fund, let's say there is a problem, there is a corruption, and the share price fell like anything. In that case you will be losing little money, right? Let's say this scenario happened for 2-3 companies. So in that case you will lose money. This is one thing. And similarly, if there is a change in the economy, if the markets start falling, so that's also there. These kind of risks are there in mutual fund. Whenever you expect a more return from bank FD, there will be more risk, right? Even bank FDs are not safe. After a certain limit, you will not get that money. For example, I think that limit is 5 lakh rupees. So even if you keep an FD of 50 lakh rupees, if there is a problem with the bank, you will get only 5 lakh rupees as per the RBI guarantee. You don't get the remaining amount, right? So there is a risk in bank FDs as well. So whenever you try to generate more returns compared to bank FD, definitely it carries little extra risk. At the same time, we can also expect little extra returns. So that is the thing with mutual fund. Now, what you can do is regarding the tax implication, you can go to ticker tape. For example, if you go to ticker tape, if you go to more and mutual fund screener, if you go to stock screening, if you take anything, for example, I will take this thing, for example, SDFC Balanced Advantage Fund. If you take this, if you open in a new page, what happens is you can see here the tax simplification, right? Tax implication. If you open this, you will get tax simplification. See 20% if it is less than 1 year, which means short-term capital gain. It's more than 12.5% if you hold for more than 1 year. So you can see all this information. For example, who are the peers, what are the portfolio. So portfolio information here, for example, 66% of the fund is allocated to equity. So remaining is allocated to bonds, debts, securities, like that. Okay. So similarly, if you go to tax simplification, you will get that information. Opinions, there are many opinions videos they are listed here. So if you portfolio, you can check everything here. Okay. So this is how you can get more information about mutual funds. I hope this video is really helpful, friends. If you think it is, yes, then you can like the content, you can share with your friends. See you in the next video with another useful content. Until then, thank you. See you. Bye bye.